Welcome to the deep dive. If you're looking for that shortcut to understanding the sometimes baffling world of global finance, you've landed in exactly the right spot.
Yeah, you definitely have.
Today, we're really getting into it. We're pulling back the curtain on something fundamental,
Yeah.
accessing capital. But we're looking at the whole range from, believe it or not, zero-cost money,
Wow.
all the way to the really grim side, financial exploitation.
And the sources we're drawing on today, they're intentionally quite different. It really highlights this huge contradiction you mentioned.
Right.
We've got European banking guides talking about how to lend millions, responsibly, mind you, to pretty high-risk creative businesses.
Okay.
And then, right alongside that, we have specific government documents from the U.S. and India detailing zero-interest loan programs and subsidies.
So real programs available now.
Exactly. But then, the contrast. We've also got this deeply troubling Human Rights Watch report. It digs into predatory microfinance, specifically these awful debt traps in Cambodia.
Wow, okay. So it's really a study in contrasts, isn't it? It shows how the rules of the money game, they just shift completely depending on, well, where you are, how much you know, maybe what assets you hold.
Precisely. And our mission today, really, is to stitch these different pieces together. We want to show you the actual tactics, the strategies that sophisticated businesses use to manage their capital costs, how they look at risk, especially in tricky areas.
And flip the coin.
And then, yes, immediately look at the flip side. The real human cost when these financial systems, instead of helping, become tools for, coercive extraction.
Yeah.
Especially targeting the most vulnerable people.
So where do we start the positive side?
Let's start with the dream. Right? Capital without paying interest. And look, these aren't just like theoretical deals or some myth. These are actual functional programs. They're designed very specifically to fix certain market problems or, give a boost to entrepreneurs from disadvantaged groups.
Okay, let's make it concrete. You mentioned a U.S. example.
Yeah, let's zoom right in. Hyper-local level first. We're looking at the city of Lima, Ohio. They have something called the Historically Disadvantaged Microenterprise Loan Program.
Microenterprise, so small businesses.
Very small. The definition is super clear. 5 employees or fewer. And the deal itself, it sounds amazing, up to $5,000 in a 1-year forgivable loan.
Forgivable meaning potentially free money.
Potentially, yes.
Yeah.
And crucially, it's at 0% interest. Think about that for a tiny business owner. That's pure working capital hitting their account, no monthly interest payment hanging over them. It's huge.
Okay, but there has to be a catch, right? Who actually gets this? The access gates, as you said.
Oh, they're strict. And that's important to understand how this subsidized capital works. This money is meant to help,
Yeah.
definitely. But it's not, designed to just prop up failing ideas indefinitely.
Right.
So it targets business owners whose personal income is low, specifically below 80% of the area median income. For Lima, Ohio, at the time of this document, that meant around $67,750 for a 4-person household. It's explicitly for people who are, financially speaking, on the margins.
Okay, so it's targeted socioeconomically.
Yes, and this is the really critical filter, the thing that shifts it from maybe just charity to a strategic investment by the city.
What is it?
The business has to have been up and running for at least 6 months. And even more importantly, it must have already generated a minimum of $10,000 in revenue.
Wait a minute, $10,000 in revenue already? That changes everything, doesn't it? Psychologically, even.
Absolutely.
It means the city isn't just funding a dream on a napkin. They're not funding a hobby. They're giving subsidized scaling capital to something that's already proven it can make money, even on a small scale. They're filtering risk right at the application stage.
You've hit it exactly. That $10,000 threshold, it's like an early stage risk assessment for the city. They know this entrepreneur isn't just starting out. They've actually managed to sell something to get customers to bring cash in the door.
So the $5,000 isn't for, figuring out the business model.
No, not at all. The documents are clear. The funds have to be used for pre-approved things, tangible stuff like buying equipment, restocking inventory, maybe a marketing push. Things designed to create measurable growth, not just, pay the rent for another month.
And what about accountability? You said it's forgivable. What if they don't meet the terms?
The default provision. It's robust. If the terms aren't met within that 1 year, maybe the business didn't hit certain agreed upon milestones or didn't spend the money as planned, then that loan is not forgivable anymore.
So it becomes actual debt?
It snaps right back into being debt, the full amount. And it gets put on an amortized repayment schedule, 2 years, paid back in 4 chunks every 6 months.
So the city uses the threat of it becoming real debt to make sure the businesses stay on track and use the money wisely. It protects the taxpayer's subsidy.
Exactly. It enforces compliance and aims to ensure the funds actually achieve their strategic goal, maximize the return on that public investment.
Okay, so that's hyperlocal. What about something a bit bigger? You mentioned another Ohio program.
Yeah, shifting scales a bit, but similar principle. Still in Ohio, but this one targets businesses based on certification, not just income. It offers zero-interest loans specifically aimed at growing certified minority business enterprises, MBEs, and women-owned business enterprises, WBEs.
Okay, so this is about addressing historical inequities in access to funding.
That's a clear policy goal here,
Yeah.
yes. And the loan sizes reflect that ambition. They're significantly larger. We're talking a minimum of $10,000, going up to a maximum of $45,000.
And the eligibility.
You need that official stamp. The business has to be certified as an MBE or WBE by the Ohio Department of Development. That proves ownership status. And importantly, the program documentation mentions targeting businesses that have had difficulty getting traditional bank loans.
Right, filling a gap. And the terms, still 0%.
Still that crucial 0% interest. And the repayment terms are much longer, showing a real commitment to letting these businesses grow without immediate pressure. Up to 5 years if the loan is for working capital, and even up to 7 years if it's used to buy equipment.
7 years at zero interest. That's incredibly favorable.
It really is. And it's important to see the difference from the Lima program. Lima's felt more about stabilizing and providing that initial boost. This MBE-WBE program with the larger amounts and longer terms feels like it's aimed at stimulating more significant systemic growth. It's providing patient, cheap capital that can actually enable major steps like, buying a big piece of machinery or maybe hiring your first full-time salesperson, things that really scale a business.
Okay, so we've seen city-level and state-level examples in the U.S. What about internationally? You mentioned India.
Yes, let's look at India's Central Sector Interest Subsidy Scheme, or CSIS. This one shifts the focus from business to education, specifically higher education access.
Same principle, though. Subsidized access.
Exactly the same core idea, using government funds to eliminate the cost of interest for a specific strategic goal. The principle here is quite powerful. The government of India essentially picks up the tab for the interest that accrues during what they call the moratorium period.
Moratorium period.
That covers the entire length of the student's course, plus 1 full year afterwards. So the student gets through their studies and has a year to hopefully find a job before they even have to think about the principal repayment starting. It's crucial breathing room.
That sounds incredibly helpful. Who qualifies for this?
Again, access is tightly controlled. It's not for everyone. The goal is to make sure the subsidy reaches those who genuinely need it most, and importantly, for specific types of education outcomes the government wants to encourage.
So, means tested.
Definitely. Students must come from what they define as economically weaker sections, or EWS. And that's defined by a specific annual gross parental income threshold up to 4.5 lakhs rupees.
Okay, so clear financial need is the first gate.
Paramount. And the loan amount covered by the subsidy is pretty substantial too, up to 10 lakhs rupees for loans sanctioned since April 1st, 2022. But here's the major strategic constraint, linking back to that idea of targeted investment we saw in Ohio.
What's the constraint here?
The focus is strictly on technical and professional courses. And not just any course they have to be accredited by recognized national bodies, like the NAAC or NBA.
Wait a second. So you have to be from an economically weaker section and get into one of these highly accredited technical or professional programs. Doesn't that create a bit of a bottleneck? I mean, if you're from a very poor background, maybe getting into those top-tier accredited institutions is already a massive hurdle, even if the interest is subsidized later.
That is absolutely the inherent tension in these kinds of strategic subsidies. You've put your finger right on it. The government is clearly aiming for maximum bang for its buck, right? They want to channel funds towards helping disadvantaged students get into high-quality careers that have high earning potential.
So it's about measurable economic uplift.
It seems so. It's a mechanism designed to drive social upliftment through very specific, measurable economic outcomes. They're concentrating limited resources where they believe the educational return on investment will be highest.
And is there an accountability piece here too, like the Ohio loan?
Yes, the fine print is very clear about commitment. If the student drops out of the course midstream, that interest subsidy is immediately gone. Unless it's for documented medical reasons. Then there's an exception.
Okay.
But otherwise, it reinforces that this isn't just passive aid. It's more like a subsidized contract. The student's commitment to actually finishing that professional training is what validates the government's investment. Fail to hold up your end, the subsidy disappears.
Okay, so these external subsidies, government programs, they're powerful but clearly targeted and conditional. But the sources you looked at also pointed somewhere else for zero-cost capital, right? More internal.
Exactly. This is where their really savvy businesses operate. They realize sometimes the absolute cheapest capital isn't a loan you get, it's a cost you avoid having to pay in the first place. This shifts us from looking for outside funding to generating, let's call it, internal zero-cost capital. And that often comes through strategic alliances and partnerships.
So not finding money, but saving money through collaboration.
Precisely. It's a fundamental shift in how you think about your balance sheet. You're not focused just on the funding needed line item, you're aggressively tackling the expenses column through smart partnerships. Financially, saving $1 in costs can be just as good or even better than bringing in $1 of zero interest funding.
How does that work in practice? Let's start with operations.
Okay, operational efficiency. The sources talk a lot about minimizing spending on redundant infrastructure. Think about it. Why should 2, 3, maybe 4 small, complementary firms, say, a graphic designer, a web developer, and a marketing consultant, all pay for separate office spaces, separate high-end printers, separate administrative staff?
Right, they could share.
They could share office space, logistics if they ship products, even administrative services, pooling resources, or think bigger, joint investments in expensive technology or R&D. Spreading that big capital expenditure across multiple partners makes it way less painful for any single company's cash flow.
Makes sense. What about the supply chain?
Huge potential there. Sharing warehouse space, maybe co-locating fulfillment centers if they serve similar customers, partnering on co-managed shipping, negotiating better rates together. It's a consolidated logistics approach. It can turn what was a big, scary fixed cost into a much more manageable, shared, potentially variable cost.
Okay, physical stuff. What about less tangible areas like marketing?
Oh, marketing and procurement offer massive internal savings. Co-marketing is a big one. Why pay for a whole webinar platform yourself when you can split the cost with a partner and cross-promote to both audiences?
So, joint webinars, sharing booths at trade shows.
Sharing digital ad costs, running joint campaigns. You're essentially doubling your reach for potentially half the cost per company. That's real savings, straight to the bottom line.
And procurement. Buying stuff.
Yeah, don't overlook the simple power of bulk discounts. Forming group purchasing agreements. Imagine a bunch of small restaurants banding together to negotiate better prices on produce or supplies. Or manufacturers creating an alliance just to get better rates on raw materials. That volume discount. That's pure zero-cost operational profit unlocked through partnership. What I find really sophisticated, though, is how businesses can structure risk through these partnerships. Instead of paying, say, a huge fixed upfront fee for a new piece of software or a marketing service.
Yeah, that can be a killer for cash flow.
Right. So instead, they set up revenue sharing agreements. The cost becomes directly tied to actual performance. Think commission-based partnerships, affiliate models where you only pay when a sale actually happens.
Oh. So you're swapping that guaranteed upfront risk, that fixed cost, for a variable risk that only kicks in if things actually work.
Exactly. It lowers that initial financial barrier to entry for launching something new, freeing up capital that would otherwise be locked into those upfront fees. It's a massive de-risking strategy.
And this risk sharing goes beyond just payment terms.
Yeah, we also see it in proactive risk mitigation. Companies using joint insurance policies to get better rates or cover bigger potential losses. Co-investment models, where multiple partners share the financial exposure if a big project goes sideways. If a disaster hits, no single partner takes a full blow.
Makes sense. What about people? Talent.
2 angles there. First, strategic outsourcing. It's a classic move, right? Outsourcing non-core stuff, maybe complex IT, HR administration, specialized customer service to firms that do nothing but that. You often get deeper expertise instantly, usually at a lower operating cost than trying to build and maintain that whole department internally.
Okay, outsourcing, what's the second angle?
This one's more about internal talent management between partners. Employee exchange programs. Sounds fancy, but it just means sharing specialized staff. Maybe your partner company has an amazing data analyst they only need 50% of the time. You borrow them for the other 50%.
Ah, so you get access to high-level skills without the full cost of recruiting and retaining that person full-time.
Exactly. It cuts down external recruitment costs, training expenses for niche skills. It's another significant source of internal capital saving, getting the talent you need without paying the full market price.
And one last area mentioned, legal. That always feels expensive.
It is. Legal and compliance costs can be a silent killer, especially for smaller or growing businesses. So collaborating here makes a ton of sense. Using joint legal counsel for certain matters, developing shared compliance frameworks if you're in the same regulated industry, it dramatically cuts down those hefty legal bills and, just as importantly, reduces the risk of costly penalties if you get compliance wrong. Optimizing compliance through partnership. That's saving potentially huge amounts of zero-cost capital. Ultimately, it just boils down to this broader view of capital. It's not just about money coming in, it's equally about money not going out, thanks to smart collaboration.
Okay, so that covers the free or saved capital side. Now let's shift gears quite dramatically. We need to talk about the complex end of the financial spectrum. High-risk, high-reward sectors where the value isn't in machines or buildings. You mentioned the cultural and creative sectors, the CCS.
Right. This is where, as you said, it gets really interesting. We've talked about zero-cost capital for micro-businesses, saving money through partnerships. Now we're looking at sectors where traditional banks often just scratch their heads.
Why? What's the core problem?
Traditional banking loves tangible assets. Stuff you can touch, value easily, maybe repossess if things go wrong, real estate, machinery, inventory. But in sectors like film, music, video games, publishing, architecture, even museums, the main value isn't physical. It's locked up in intellectual property, or IP, copyrights, trademarks, patents, designs.
And banks don't like lending against ideas.
Generally, no, not without a specific framework. The European Investment Fund, the EIF, recognized this. They saw that standard commercial lending practices just flat out don't work well for CCS businesses because the risks are so different, so intrinsic to the sector.
What are those specific intrinsic risks? Can you break those down?
Sure. First, there's massive uncertainty about market success. It's often called a hit-based business. You can pour years and millions into making a movie or developing a game.
If it could just flop.
Completely flop. And if it does, the value of that specific asset, that film or game, can plummet practically overnight. There's also intense cash flow volatility. Revenue comes in big chunks, often unpredictably. And the projects themselves can take a really long time from initial investment to any potential return. All of this makes traditional lenders very nervous.
So how do sophisticated institutions like the EIF advise banks to handle this? They must have a process.
They do. To try and bridge this gap, the EIF outlined a specialized three-step lending process specifically for financial institutions dealing with CCS, small and medium-sized enterprises, or SMEs. Understanding this process is key to seeing how they try to mitigate risk when the asset is intangible.
Okay, step one.
Step one is origination. This is really about education and building awareness within the bank. The bank needs to understand the actual economic potential of the CCS. They need to grasp the specific value chains, like how does money actually flow from a songwriter through a publisher to a streaming service and back. It's not always obvious.
So the bank needs homework first.
Lots of it. And part of that homework is identifying existing public support schemes. You mentioned the InvestEU guarantee product earlier.
Yes.
That's a perfect example. These guarantee products often provide risk sharing. They might cover, say, the first tranche of losses on a loan portfolio. This external risk mitigation from a public body makes the bank far more comfortable even considering lending to these riskier sectors in the first place.
Okay, so origination is about getting the bank comfortable and aware. What's step two?
Step two is underwriting. This is the absolute core of the risk assessment. And this is where valuing those intangible assets, the IP, becomes everything. How do you put a number on something you can't physically touch or easily sell on the open market?
Yeah, how do they do that?
The key method the EIF highlights is the income economic benefit method. Lenders aren't trying to value the desks or computers in a film studio. They are meticulously forecasting the future income stream that the IP is expected to generate. Royalties, licensing fees, ticket sales, streaming revenue, all the economic benefits projected over time.
So they're valuing the cash flow, not the thing.
Precisely. It means the bank's due diligence shifts dramatically. Instead of auditing physical inventory levels, they're vetting contracts, analyzing licensing agreements, assessing the track record of the creators. They need to verify the quality, the potential longevity, and the contractual certainty of that future cash flow stream. They also look at things like patent expiry dates, how much value is left.
Okay, valuing the IP based on future income. What else in underwriting?
They also have to get smart about analyzing cash flows. As we said, cash flow in CCS is often volatile, lumpy. A traditional banker might see that lumpiness and just reject the loan. But the EIF says no, that volatility should trigger deeper analysis, not outright rejection.
Deeper out.
Check the feasibility of the production timeline. Is it realistic? Review the historical track record of the company or the key creatives. Not just if they generated revenue before, but look at the quantity and quality of their past content. Does it show they can consistently produce and monetize creative work? It's about looking for patterns beneath the surface volatility. Assessing project feasibility, will this specific project likely resonate? How effective is the marketing plan?
Got it. So origination, underwriting. What's step 3?
Step 3 is closing and monitoring. Since the usual financial covenants might not fit perfectly, this requires a more tailored approach. Specifically, using a bespoke risk management dashboard built around key risk indicators, or KRIs.
KRIs, so specific metrics for these industries.
Exactly. They're industry-specific performance markers that give the lender early warnings if things are going off track.
Yeah.
For instance, in video games, a bank might monitor metrics like ARPPU, average revenue per paying user, and also the conversion rate, what percentage of players actually spend money. Why is ARPPU so critical? Because it shows if the monetization model is actually working and sustainable. It indicates the health of the cash flow from engaged users, not just the total number of downloads, which might be fleeting.
Makes sense. And for something like film production?
Monitoring for film often happens against a very detailed, granular schedule of pre-agreed milestones. Things like securing the lead actors, completing principal photography, reaching a certain stage in post-production. Each time a key milestone is verifiably met, the next chunk or tranche of the loan is released.
So the bank doesn't release all the money up front. They release it in stages as the project proves it's progressing.
Precisely. It's a mechanism to keep the project on track and limit the bank's exposure if things fall apart early on.
Now, the sources mentioned some really specialized loan structures used in CCS that sounded, well, quite ingenious for dealing with this volatility, gap financing and slate financing.
Yes, these are crucial tools. Let's take gap financing first. This is a highly specialized type of bridge loan, very common in film and also used in video games. Its whole purpose is to fill the time gap between when the production needs cash and when certain secured future revenue streams are actually received.
Secured future revenue? Like what?
Think signed distribution contracts, confirmed pre-sales to territories, or, and this is often the most important one, government tax rebates or credits. Many countries offer these to incentivize local production.
Hold on. So the bank isn't just lending against the potential success of the film.
Yeah.
They might be lending against a tax rebate the government owes a production company.
You got it. That's often the core of gap financing. Because those tax rebates or credits are essentially guaranteed receivables from a government entity, they represent exceptionally high-quality collateral. There's very little counterparty risk compared to, say, relying on box office predictions. So the bank provides a short-term loan that gets repaid automatically when the government rebate comes through. It fundamentally changes the risk for the lender. And for the producer, it unlocks vital production cash now based on that future, practically certain, government payment, rather than waiting potentially years for the money to flow back through the entire distribution chain.
That is clever. Okay, what about the second one, slate financing?
Slate financing is different. Instead of funding a single project, it's about financing a portfolio or slate of multiple projects at the same time. This is most common, according to the EIF guide, in the recorded music industry.
Why music specifically?
The key insight here is the rise of digital streaming. Established record labels or music publishers have back catalogs of existing songs. The revenue from streaming those catalogs, while maybe not individually huge per stream, is incredibly predictable and recurring when aggregated. It acts almost like an annuity.
So the old hits generate steady cash flow.
Exactly. So a lender can provide financing for a new slate of albums or artist development, secured not just against the potential success of the new music, but against the reliable, ongoing cash flow from the existing, proven catalog. It's a portfolio approach. The predictability of the catalog significantly de-risks the investment in the new, unproven projects. It's also sometimes used in video games, funding new game development based on ongoing revenue from already released successful titles.
So it really shows that when capital access is structured correctly, using these specialized contracts, sophisticated risk analysis like gap and slate financing, it can actually fuel growth even in these really innovative, high-risk creative sectors. The financial system finds ways to reward creativity by essentially quantifying the intangible value.
That is the absolutely critical takeaway from the world of sophisticated finance. Yes, they find ways. But now we have to turn to the dark mirror of finance. Because when access to capital isn't structured carefully, when it's unregulated, or worse, deliberately predatory, The consequences are just devastating, especially for vulnerable populations who often don't have intangible IP but maybe only possess tangible essential assets, like their land, used as collateral.
Predatory lending. How did the sources define that?
It's defined pretty clearly. Extending credit or collecting payments on that credit using methods that are unfair, deceptive, or outright abusive. Crucially, it involves disregarding the borrower's actual ability to repay the loan. The lender's aim is simply to maximize their own profit with no regard for the borrower's financial stability or well-being.
And you mentioned the Human Rights Watch report on Cambodia's microfinance sector as a case study here.
Yes, it provides a really stark, painful example of how this plays out on the ground. It's important context that many of the microfinance institutions, or MFIs, involved actually started out as nonprofits. Names like AMK, AMRET, LOLC, they had missions to help people.
But they changed.
Over time, many transitioned into intensely profit-driven businesses, often funded by large international development finance institutions and private investors seeking financial returns.
And the report focused on indigenous communities.
Yes, specifically in regions like Ratanakiri, where poverty rates were already known to be higher than the national average. And the core damning issue highlighted is how these MFIs prioritize the collateral over the borrower's actual capacity to repay.
How did that work? What was the collateral?
Their land. MFIs approved large loans based almost entirely on the assessed value of the borrower's land. Worryingly, they often accepted soft titles. These are informal, customary land documents, not official state-issued titles as valid collateral.
Even if the borrower couldn't realistically afford the payments?
That's the crux of it. This happened even when the lenders, based on the borrower's stated income or lack thereof, likely knew, or certainly should have known, that the borrowers had inadequate income streams to actually handle this scheduled loan repayments. It essentially set people up to fail from day one.
And when they couldn't pay, the collection tactics
Were described as incredibly coercive, designed, it seems, purely to extract payment, regardless of the human cost. The report details several specific abusive tactics used by the MFI credit officers.
Like what?
Well, first, there was outright deception about the loan's purpose. Officers apparently encouraged borrowers to falsely write down starting a micro-business or business investment on the forms,
Even if that wasn't true.
even when the money was actually needed for, say, a health emergency or food, or often, and this is critically damaging, simply to make a payment on another existing MFI loan.
So pushing people into taking new debt just to service old debt? That sounds like a spiral.
It's exactly that. A disastrous cycle the report calls loan juggling. It's insidious. The MFI officer themselves might encourage a borrower to take out a new loan, sometimes from the same MFI, or push them towards informal, high-interest moneylenders just to make the current payment.
Digging the hole deeper.
Infinitely deeper. The report documented 47 indigenous borrowers who said they'd taken out new MFI or informal loans specifically to pay off existing MFI debt. It creates this permanent, inescapable treadmill of indebtedness.
Beyond the deception, what about direct pressure?
Relentless harassment. Credit officers visiting homes repeatedly sometimes, according to borrowers, up to 3 times in a single day. Constant intimidation.
Threats.
Regular threats of legal action, bringing in the police, taking them to court, imposing heavy fines.
But is it actually a crime not to repay a loan in Cambodia?
This is a critical point the report makes. No, there is no criminal penalty for failing to repay a loan. It's a civil matter. Yet, officers routinely use the threat of arrest, jail, or court action, things people deeply fear, to terrify borrowers into finding money somehow.
That's awful.
It gets worse. Many of the indigenous borrowers couldn't read Khmer, the language the loan documents were in. They reported being pressured, coerced into putting their thumbprint on complex repayment agreements they didn't understand, often under the direct threat of the authorities being called if they refused.
And the ultimate consequence of all this pressure? Losing their land.
Tragically, yes. The report documented 13 specific instances where borrowers were forced into selling their land. And importantly, these sales often happened outside the formal legal foreclosure process. It wasn't a court ordering the sale. It was intense pressure from credit officers demanding repayment, leading borrowers to sell their land, often their only means of subsistence farming, just to get the MFI off their back, an irreversible loss of their livelihood and ancestral heritage. And the impact ripples out beyond just the debt itself, right? The human toll.
Absolutely. The report links this crushing over-indebtedness directly to really harmful coping mechanisms within families. Things like cutting back on food, eating less, just to scrape together money for loan payments.
And children.
Children being pulled out of school, either because the parents desperately needed them to work and earn tiny amounts of money, or simply because the family could no longer afford even basic school fees or supplies due to the debt burden.
And the psychological pressure. You mentioned extreme cases.
Yes, the report disturbingly links the immense stress, the constant fear of authorities, and the shame associated with the debt to suicides. It documents the specific, heartbreaking case of a man named Sukchea. He received a threatening letter demanding he meet with local authorities about his debt. He was reportedly so terrified of what would happen that he took his own life.
It's just devastating. And this points to a failure beyond just the individual MFIs, doesn't it? What about the regulators?
It seems like a major systemic failure. The report mentions that the National Bank of Cambodia, the central bank, cited consumer protection laws that exist on paper. But when Human Rights Watch asked them for specific examples or data on enforcement, like, had they actually penalized or sanctioned any MFIs for these kinds of violations? The NBC apparently provided no instances. Suggests a serious gap between the rules existing and the rules being enforced.
What about the international investors? The development banks, didn't they have safeguards?
That's another critical point. International investors like the IFC, the World Bank's private sector arm, often pointed to voluntary industry codes, like the Cerise plus SBTF client protection principles, as evidence that borrowers were protected. They'd say, look, the MFIs we fund adhere to these standards.
But did they?
Well, here's the catch. Those very standards include indicators about debt burden. One key threshold is that borrowers generally shouldn't be paying more than 70% of their monthly income just towards debt repayment. That's seen as a major red flag for over-indebtedness. Yet the research conducted for the report found that in Cambodia, an estimated 15% of microloan borrowers were paying over that 70% threshold, even while some of the MFIs involved claimed to be certified under those very client protection standards. It really reveals the deep flaws in relying solely on voluntary, often self-reported industry codes when profit motives are strong.
So, if the system is failing this badly, what are the proposed solutions? How do you fix something like this?
The remedies suggested in the report are systemic and pretty drastic, reflecting the scale of the problem. They talk about needing systemic debt forgiveness or, at minimum, substantive debt restructuring on a large scale.
Getting people out from under that crushing weight.
Exactly. Also, concrete steps towards the recovery of indigenous land that was lost through these coercive sales, and, critically, speeding up the formal process of collective land titling, CLT, for indigenous communities. Because that whole process is undermined if MFI lenders are holding those informal soft titles as collateral, giving them leverage over community land decisions.
It really is the ultimate financial dichotomy, isn't it? You have one part of the system developing these incredibly sophisticated, low-risk lending tools based on forecasting the future value of intangible ideas in Europe.
Right, like the slate financing for music catalogs.
Exactly. And then simultaneously, you have another part of the system, often funded by related international capital flows, that seems to deliberately ignore basic repayment capacity in order to secure loans against vital, tangible assets like land, primarily from the most vulnerable populations in the developing world. It's almost like two different planets financially.
So wrapping this deep dive up, we've really journeyed across the entire spectrum of financial access today. On one end, yes, sophisticated, even zero-interest financing absolutely exists. We saw it in targeted government programs in Ohio and India, and in the clever ways businesses use strategic partnerships to basically create their own zero-cost capital by saving money.
But accessing that good capital, it requires meeting really strict criteria, having the right certifications, maybe leveraging valuable intellectual property, or finding those specific high-quality collateral types like government tax rebates that underpin things like gap financing. It requires a certain level of sophistication and specific types of assets.
And then the other end of the spectrum. For the financially vulnerable, particularly those in places with weak regulation or enforcement, access to capital can mean something entirely different. It can mean being targeted for large loans based not on your ability to repay, but solely on the fixed value of your essential assets, like land.
An asset extraction model, really, rather than a growth or empowerment model. And as the Cambodia case tragically shows, this leads directly into these coercive cycles of debt, serious human rights abuses, and ultimately can deepen poverty instead of alleviating it. It starkly reveals where financial system priorities can sometimes fall when profit is the main driver.
It's striking. We looked at a world, through the EIF documents, where the future expected revenue from a catalog of recorded music can be meticulously quantified, valued, deemed low risk enough to secure potentially millions in slate financing. The system recognizes and assigns a high financial value to that IP.
Yet in the other context we examined, the fundamental value of ancestral land, the value of subsistence, the value of basic human dignity when threatened by microdebt and coercive collection practices, seems to be ignored or discounted by the very financial institutions, including international ones, that often claim their mission is to stabilize and uplift developing economies.
So the final thought to leave you with is about this stark contrast. What is the maybe psychological toll, not just on the individuals caught in these systems, but on global stability? What does this dual reality, sophisticated financial inclusion for some, predatory exploitation for others actually mean? And what responsibility might we have as informed people to demand that finance ultimately serves humanity, not the other way around?
That's really the core question, isn't it? Something essential for you to consider as you reflect on the different sources we've unpacked today.
We really encourage you to think about the role of due diligence, whether you're seeking capital yourself or involved in institutions that provide it. Consider the structures, the incentives, and the potential impacts. Thank you for joining us for this deep dive.
We'll talk to you next time.